So from all the chart studies from super traders like Mark Minervini, William O'Neill, there's one thing that stands out. Stocks make their biggest, fastest gains only in stage 2. But what exactly is stage 2 and why is it so powerful? In my earlier video, I promised that I'm going to break down concepts from this one book that I'm going to read only for this year, which is Mark Minervini's classic Trade Like a Stock Market Wizard. So today I'm sharing my notes straight from his playbook on the non-negotiable criteria that he uses to find super performers by identifying stage 2. And in this video, I'm also going to give you his exact trend template that he uses to confirm a true stage 2 uptrend. Alright, so let's dive in. And before I share his priceless trend template, let's first exactly understand what a stage 2 uptrend in a stock exactly means. So have you guys ever wondered why a stock suddenly shoots up and then just probably stalls or suddenly crashes? You know, it's not actually random. It's stage analysis. The 4 stages of a stock's life cycle: consolidation, accumulation, distribution, and capitulation. Alright, let's begin with the first phase, the neglect phase or consolidation. This is the quiet before the storm. The price moves sideways in a tight range, stuck around its long-term average. The volume is light, and honestly, nobody cares. The earnings might be flat, outlook uncertain. The market looks boring, but behind the scenes, smart money, big institutions, they could be loading up. Why? Maybe because the company is innovating, or maybe it's scaling, or maybe it's preparing for a big launch. For traders, this is the watch and prepare zone. Look for subtle signs like volume suddenly increasing or the price refusing to drop down on bad news. That's your clue that a breakout might be coming. Stage 2, the advancing phase or accumulation. So after the sideways move, then comes the boom. Out of nowhere, the stock wakes up. Earnings surprise to the upside, the demand surges, and the institutions start piling in. The volumes spike on rallies, the pullbacks are quiet, and the stock starts to climb that beautiful staircase of higher highs and lower lows. Minervini calls this the only stage worth trading. This is where super performers are born, not at the bottom, but once the trend is in motion. And this stage, it might come without a warning. A stage 2 advance can also be ignited by a surprise news, such as a beneficial regulatory change, a promising business outlook, or a new CEO whose vision can improve the company's prospects. Or perhaps it's just like a new company which suddenly attracts notice with a big earnings surprise that beats the estimates. Now we come to stage 3, the topping or the distribution phase. So every party has its peak level, and this is it. The stock's still high, but something feels different. Earnings growth slows a little, volatility picks up, and institutions quietly start slipping out the back door. At this phase, you'll notice choppier, wide swings, big red bars on heavy volume, weaker green days, and the stock always dancing around the key moving averages. This is distribution. The big money is selling into strength while latecomers, late bloomers are still buying on the headlines. Our job out here is to be cautious. Watch for signs of weaker volumes on up days or price failing to make new highs. This is basically when you tighten your stop losses and start booking profits or prepare for what's next. And sometimes if the company reinvents itself and finds new growth, it can then loop back to stage 2 and start a fresh new uptrend. The last stage is stage 4, the declining phase, capitulation. So after the distribution, then comes the slide. Earnings disappoint, guidance gets cut, and the selling snowballs. The stock breaks down into lower lows, lower highs. Again, a staircase, but this time pointing in the downward direction. This is a slide which you do not want to ride unprepared. This is capitulation, the brutal mirror image of stage 2. Unless you're shorting, stay out. Because once a stock is in free fall, then hope is not a strategy. So these are the 4 stages. Stage 1, the neglect phase or consolidation, where the stock doesn't do anything, moves sideways, and there may be subtle hints of institutions loading up. Then stage 2, which is the advancing phase, accumulation. Here the stock breaks out with aggressive buying. Then stage 3, topping phase, distribution. Smart money sells to the crowd. And stage 4, declining phase, capitulation. Prices fall as selling accelerates. So these are the 4 stages of a stock's life cycle. But here's the big question. How do you accurately pinpoint stage 2? It can be tricky, right? Well, this is the part which you guys have been all waiting for. Mark Minervini's famous trend template. And here's why it matters. Minervini studied decades of market history, and this is what he found, which was fascinating. Almost every super performer stocks was already in a solid uptrend before it made massive moves. We're talking 99% of them above the 200-day moving average and 96% of them above the 50-day moving average. Think about this. These big winners weren't found lurking at the bottom. They were already climbing up. So how do you catch them? That's That's where Mark Minervini's trend template comes in place. This is a non-negotiable checklist for spotting a true stage 2 uptrend. So if the stock doesn't pass all 8 criteria, Mark Minervini doesn't even look at it. The fundamentals might be exciting, the story might sound amazing, but if it's not a confirmed stage 2 uptrend, then it's a no-go. It's a no trade. So here is his template in plain English. So point number 1, the price should be above the 150 and the 200-day moving averages. Point number 2, the 150-day moving average should obviously be above the 200-day. Point number 3, the 200-day moving average should be sloping upwards, at least for a month, preferably 4-5 months minimum in most cases. Point number 4, the 50-day moving average is above the 150 and the 200. Point 5, the price is above the 50-day moving average. Point 6, price is at least 30% above its 52-week low. And often the big winners are 100%, 200% above it before they start making their big moves. Point number 7, price is within 25% of its 52-week high. The closer to the new highs, the better. Point number 7, the relative strength should at least have a ranking of 70 or preferably 80 or 90. Now, when all this lines up, congratulations, you've got a confirmed stage 2 uptrend. That's the tide coming in. But here's the catch, the tide doesn't rush in all at once. It comes in waves, and stage 2 works the same way. The stock doesn't just go straight up. You'll see bases formed along the way, usually lasting 5 to 26 weeks, where the price goes sideways, kind of like the stock catching its breath. These consolidations are not stage 1 anymore. They're like mini pauses inside stage 2. Think of it as a stair-step pattern. Rally, base, rally, base, rally, base. Each wave taking the stock higher. And that's how Minervini times his trades. He doesn't just buy any stage 2 stock. He waits for those powerful breakouts within the stage 2, riding each wave of the tide. So after going through all of this, I looked back at my trading journal, full of red trades. Blah. And I thought to myself, why am I even buying stocks which are not in stage 2? Why? Seriously.